How has QE affected or impacted the housing crisis? So I've done a few videos on TikTok about the housing crisis, and this one's going to take a bit longer than a 1-minute TikTok restricted video, right? Now, normally I lean aggressively towards, we just need to build some more houses. And though sometimes for a complex problem, it can be tempting to lean towards a simple solution, actually sometimes what you need is a complex explanation of the problem. So here we go. QE, housing, from the top, strap in. So let's start from the get-go. Some people loan money to the government and the government pay them interest for a fixed period. Let's say 1.6% every year for 10 years, and then they get their original money back. That arrangement is called a bond.
I'm going to put my life savings of £300,000 into a government bond, and they're going to pay me 1.6% every year. So that's 4.8k sorted for the next decade. Boomtown. Population me.
Now that's reliable income for someone who's a fan of security, you know, like pensioners or rappers at the Source Awards. And then 10 years later, you get your 300 grand back. What's not to love? Older investors traditionally liked bonds because it's not like investing in a company where they might go under or have a bad year or not pay a dividend.
Workers are losing not only their jobs, but also their retirements as Enron stock keeps plunging.
Yeah, I think that many people have lost a substantial amount of money.
And it's not as volatile as investing in currencies or crypto.
Yo, watch this. I'm going to buy £50,000 with my 70,000 US.
Hank, the pound's just crashed, yeah? It's going to take you a decade to get your 70,000 back.
For the love of God.
Instead, governments like Britain's can say, loan your money to us, you'll definitely get it back, and we've never not paid annual interest on a bond. So it's a safe place to keep your money at a time in your life when you probably just want to know everything's cushy. In fact, pretty much all of wealth management is predicated on the idea that as you get older, you will shift from riskier assets like currencies and equities to stuff like bonds. So how does this connect with QE, right? Well, that money they pay granddad, the return every year, the yield on the bond.
Boomtown.
That used to be pretty good. It was 15% in the 80s. 100 grand in bonds would get you 15k a year back. That's not bad for a retiree.
I'm a hustler, baby.
But as interest rates tumbled, now it would get you about £1,000. It's 15% down to about 1.6%. So understandably, lots of grandmas and grandpas have abundantly abandoned or binned their bonds. Now, in this period of uncertainty and minuscule returns, a lot of investors have said, well, maybe fuck bonds to death. Maybe I'll just invest in Amazon or property instead. And that has left demand for bonds lower and existing bondholders selling them off. So a growth in supply and little demand for buying. Now, if lots of bonds flood the market like that, but the government still wants to borrow more money, which we always do, they'd have to entice you to buy the bonds, right? So they might increase that yield again. Maybe now it's 1.7% or 1.8%. But for the Bank of England, that costs more money in the form of paying out more yields year on year. But the only alternative is to not pay a higher yield and see the asset continuously dilute in value.
Should I let my product stall and sink further into the market abyss, or should I entrench myself further in debt? It really is a tricky one.
Okay, fuck all that for a second. Bonds, yields, diluting the value. Just imagine it's a used car salesman, right? And he needs to get rid of his stock. He can either slash the price of all the cars and try and get rid of them that way, or he can start tossing in extras. But either way, he's kind of losing money in a troubling market where no one wants to buy your shitty used cars, Gary. And now into QE.
Bloody finally.
Quantitative easing, or QE, is artificially creating money out of nothing, just printing money, and the government uses most of that money to buy back bonds themselves. And that solves three problems for them. Number one, it means the demand for investing in government is kept artificially high, so we can borrow and continue to invest and service our public services, right? Number two, they don't have to increase yield returns because why would they? These bonds are selling perfectly well without them. Number three, 3, it means the grandmas have their 300 grand back and they can go out into the economy and spend it on booze, bingo and Buble tickets. And that last one is the goal, right? If you have more money out in the economy, wealthy people spending it, getting taxed, the real economy, not the magic money, will kick in and people's income and taxes will show up, and one day we'll be able to stop dishing out these unicorn dollars. #goals. But in times of uncertainty and global financial crashes and Brexit, the wealthy types who invested in instruments like bonds, rather than blow it on bingo or blow, have just reinvested it in more reliable, robust areas. And it's been argued that Gordon Brown's tax raid on pensions pushed older investors away from traditionally safe assets out into the wild. And the output of that is older investors looking for somewhere to put their money. And the output of that is an overheated stock market and a huge property bubble. Let's say you're 67. This is your last roll of the dice at financial security for you and your kids and your grandchildren. You've got the option of investing in bonds, and there's a 1.6% return on an annual basis, or you can buy a flat or a house, and it's going to grow in value by 7% every year, and you can make money on the side by renting it out. You can see why people might shirk the volatility of the stock market and the low returns of bonds and instead move into property. So huge swathes of people use their savings, their bonds money, and sometimes just loans to invest in property. It's a triple whammy of retirees investing in second homes, slower and slower house building, much tighter mortgage regulations for younger or like first or second time buyers, or the total absence of 100% mortgages now. All of that has created a crunch where the supply of homes just simply hasn't met demand. But it's so much bigger than just we haven't built enough houses. Now I know all of that sounds bad, but it is so much worse. Arguably, the more worrying side of QE and housing is the dilution in value, not of bonds, but of money itself. If we're endlessly printing more and more money, manufacturing it out of thin air, at what point do people start saying, this currency is not worth the paper that it is endlessly printed on? At what point does everybody just say, well, maybe none of us buy bonds anymore, given it's an investment in Britain and the returns are poor and the British currency is just a smoke and mirrors game of unicorn dollars? Where does the British government borrow from then? And what happens to public services that we can only improve or service with borrowed money? The average cost of a house now in some parts of the country is 8 to 12 times the average salary in the same area. And the value of money continues to decline, and people start to see property as a store of value rather than cash. Then the value of a house will continue to incline, while the value of your salary will fall. That's why it's not unreasonable to think that if we continue on the same trajectory, the cost of a UK house could easily get to 12 times the average salary, 15 times, 20 times the average UK salary. So if the question is, how has QE affected or impacted the housing crisis? The answer has to be in the same neighbourhood as it has driven the problem, and it has turbocharged inequality, and it will continue to do so until we stop trying to quench our thirst on this burst fire hydrant spraying out magic money.